Good morning, everybody. Welcome to Friday morning and to today's live stream. As always, I'm looking forward to our discussion today and excited to talk about what's going on in the markets and relate that information to what we're doing with our trades. There's a lot, as always, there's a lot to talk about. The interesting thing, let me switch really quick here over to my track record. Um, this is just the log that I keep for my trades. Um, the interesting thing is that there's actually not a whole lot of open trades to talk about this week. Good morning to Barry and Gib. Appreciate you putting some comments in the chat area. You can use that area to drop comments or questions, and I'll be paying attention to that throughout the course of the live stream. Um, so please feel free to do that. There's really only a couple of open trades that we're really going to be talking about today. So that means that we're going to have some time to open up the discussion a little bit to some of the things that you may be looking at and possibly to take the direction, or excuse me, take today's discussion in a couple of different directions. May be able to walk through some analysis, some deep dive analysis into some of the fundamentals of some things you may be looking at. We'll just kind of play that by ear and see where we land. In the meantime, though, let's go ahead and dive in. I want to start by just I think that current conditions are always a good reason to try to get a sense for the temperature of the market. And so I wanted to start by doing that today. Obviously, we're live exactly while the market is just opening, and so we've got some brand new information to work off of as things are just getting started. But it is interesting to me to let's see. I need to open up my drawing tool. Give me just a moment. There it is. Okay, perfect. All right. Switch my color. Now, last week when we looked at the market, we were looking at it up here in this range, just a little bit below the 200-day moving average, and talking about it sitting at around support at that level. And clearly, what we're looking at here is a little bit of a breakdown, especially in the last couple of days, where we've dropped below that. We've also broken we appear to be breaking what would have been the last pivot back here, actually, the end of last week, which is right around 64.50 roughly. And so we may be looking at confirmation of this break below the 200-day moving average. So what do you think that means? Let's throw this out to the group a little bit. What do you think that means for the market right now? How is this affecting the things that you're paying attention to on your watch list in terms of the trades that you're placing? Go ahead and put your comment in, and let's open up the discussion a little bit here. I'm gonna while you're doing that, I'm gonna try to do a little bit of try to identify some pivots here. Barry, before considering a put option, you're trying to wait until it stops falling, waiting for it to stabilize, and that's always pretty good practice in general, right? The temptation is to sorry guys, the temptation is to jump in as soon as you see the value proposition and the premium offered looking very nice. And I'm not necessarily afraid to do that if I think the stock could be stabilizing. However, the risk, if you see things where, if you see a chart where bearish momentum is picking up, kind of like what it's doing now, the risk is that you may be catching a proverbial falling knife. And so there's some wisdom in what you're talking about, Barry. I appreciate that comment. The lines that I'm trying to draw right now, if we're talking about a legitimate breakdown right now, I'm trying to see where the next likely levels of support are likely to be. Sorry, and I just used likely multiple times in the same sentence. I'm not using these green lines to suggest that this is where bearish momentum resumes. I'm simply using green as a sign of support, red as a sign of resistance. So all of these different lines are levels where we could see some opportunities for what is now becoming an intermediate downward trend in the market start to pause. And I think that that's something to pay attention to right now, because from really about this point, we're seeing. See, yeah, this is late January, really. So this is still a relatively short-term upward trend, but it is starting. Hello, Jay. We are starting to shift, and I do see things starting to extend into a longer time frame. So when you see short-term trends extend into intermediate trends, that does imply that momentum could continue to follow this new direction. So we have our support lines here. We have one at about 60. What is this? 63.70 roughly. So this is like this, assuming that this bearish momentum continues, it looks like this 63.70 is going to be the next level where the market should hopefully try to see some stabilization. Barry, do sometimes throw caution to the wind if the premium has higher outside the norm to pull in immediate income. I mean, you've seen me do the same thing. So if the opportunity is right, then that doesn't totally scare me away. But do it mindfully, right? Understanding that risk may be increasing in the short term. If this leveled around 63.70, which is about 70 points away from the market right now, that's not too far away. That's, considering the kind of volatility we've been seeing, that could be within striking distance in the next day or two. Then we also have this level. Sorry, we have this level at about 62.40. So that's about 200 points below the market's current level, and then again down here at about 61.34 roughly. So these are interesting levels to look at. And again, a bounce or a break below any of these levels would be something that I would take as a likely indication that this bearish momentum is likely to extend into a longer term time frame. Now, does that scare you away from the market? Maybe. let's get real and talk in real terms for a minute here. These are cautionary signal lines, right? The very least, any movement around these levels are things that, in my book, you should pay attention to and consider very carefully against the trades that you are thinking about taking. Um, if you aren't already, and I'm gonna yes beat this position sizing drum again. If you aren't already making the sizes of every single trade you make as conservative as possible, then these kinds of conditions are exactly the kind of thing that should prompt you to begin pulling things back. Um, I'm trying to stay very, very much within the no more than 2 to 3% range, and if I can shorten that even a little bit and even get a little bit below 2%, then I think that's a in good thing to do right now. Um, doesn't mean that I'm becoming more bearish. It just means that I am trying to pay attention to what is going on in the market, and I'm trying to I'm trying to respond appropriately. I'm still going to look to take advantage of opportunity when I find it. I'm a contrarian. That means that bearish conditions don't. I'm not going to say they don't scare me, but they don't push me away from the market. They don't make me avoid opportunity if and when I see it. They just make me try to think about things a little bit longer and a little bit more cautiously, and try to make sure that the plan that I'm putting in place makes sense. The All of the elements that I need for the trade I'm considering um, fit the way that I need them to. Okay, so there's a little bit of a soapbox. Let's go ahead and put that to bed. Let's dive into the trades that we're paying attention to now. We really only There's only one trade this week that is set for expiry. Everything else is going out into the second week of April, and there's only a couple of put sales to consider there, including this week's trade. So we'll be getting into those. But let's start with CVS and take a look at what is happening there. Here's CVS. Now, just for reference sake, make this a green line. Actually, this should be red. Now it's resistance. $75 is the strike price that I sold on my put sale. Bad handwriting, I'm sorry. We can see clearly that the stock is broken down below that level, and it does appear to have a little bit of stabilization right down here around 71. We'll see if this holds. It bounced last week at around 71, rallied for a bit, and then it turned back again. And we're back near that 71 level. So we'll see if this holds or if it breaks down. I don't know. I'm not going to try to guess what it is going to do right now, but it could break down and go below 71. If it does, then of course the next question, just like we were doing with the broader market right now, the next question becomes, where is the next level below that? So here is that. Interesting how current level lines up with this pivot from back in April of last year. There's possibly 69. Maybe go back a little bit further. Okay, so it looks like probably if this doesn't hold, we're looking at a stabilization somewhere between 69 and 68. That That's quite a bit away from the $75 strike price that I was assigned at, which isn't awesome. But again, this is where I'm coming back and I'm relying on the data that I'm pulling from my fundamental analysis, my valuation, and I still really like CVS at 75. So this strike price that I was assigned at doesn't terrify me too much, and so I'm willing to kind of ride this out and let this play. But again, this is also something where, again, it's not to turn a blind eye to what the market is doing. It is to try to think about this in very practical terms. So I am going to be assigned. That is my that's my normal method here, is to let the result become the result. If I'm assigned, I'm assigned. I'm already going to be about $4 underwater on this. And it may not rebound quickly. So I may be holding on to this for a little bit of an extended period of time. Now, this is a dividend paying stock, so that is something that that dividend is going to give me some passive income, which is nice. But I need to be aware of that potential downside, and I do need to decide if that is something I'm going to be willing to absorb. You see me write in every single one of the trades that I highlight that I'm willing to take the assignment at that price. So this is a normal part of my consideration before I ever place a trade. This is also, however, still, even with that in mind, something that for me is important to think about literally every day as I'm evaluating my trades and evaluating where things are going. Is the question should become: are conditions still such for this company, for the fundamentals, et cetera, that I'm still willing to stay in this trend? I'm still willing to hold this position. So let's take a look here really quickly. If I did want to get out of this trade before the market closes today, what would I need to do? Here's the $75 strike price. Now, if I wanted to close this position, I'd have to pay the asking price. So that would be a buy to close order using the asking price as a reference. Here's the last price is $3.95, so that's interesting. There's a big difference right now between the bid and the ask. Let's take a look at the contract details. The reason for the difference in the spread is simply because of really not a ton of open interest here in this contract. This is one of the things that can happen sometimes if you're when you work with options with not a ton of open interest. It doesn't mean you can't place some functional trades, but it does mean you're going to be dealing with longer periods in between transactions. You may not get exactly the price that you want, and if you do, you may have to wait a little bit longer for it. So the last trade here was $3.95. Yeah, Barry, under the circumstances, probably wouldn't get much of a break on the buyback price. Most likely pay closer to the asking price. I agree with that. The last trade was yesterday at close at $3.95, and with bearish momentum accelerating a little bit, I might be able to put in something like a buy to close if I wanted to avoid the assignment here. Maybe I go at 450. This isn't a recommendation to buy or sell. This is just, I'm throwing out numbers. Literally, I'm just pulling this one out of thin air. But remember, I brought in $1.70 in terms of the credit on the put selling trade. So my loss on this is going to be well, let's just go ahead and give in and use the calculator, shall we? All right. Yeah, that's interactive. So, oops, there we go. All right. $1.70 minus 450. So the net loss I'd be absorbing here is $280. I sold one contract. Oops. Give me a moment. So I'd have to absorb a loss of about $280 on this. And this is, so about $280 total for to close out the one contract. That's actually not terrible in terms of loss management when all is said and done. So if you did want to try to avoid the assignment, that's not the worst strategy. Barry Joe would still do it. Yes. Apparently didn't like the stocks, just the trading. He would take the loss, try to get some of it by rolling it down. And so that's absolutely true. If you are going to be the kind of person that is managing a trade more actively, and let's face it, somebody like Joe or some of our other rollers, Ray and the others, would also not have. There we go. Our active rollers would not have waited until the day of expiration to close out this trade. Let's go back to our chart here. As the stock was breaking down below this 200-day moving average, in fact, that would likely have been the signal point for them to get out of that trade and think about rolling it down. But in the spirit of what you're talking about, let's just go ahead and say I put in a buy to close order on the 75 that expires today. What could I do next? Well, here's next week's trade, which is interesting. $1.10 at the 71, which is the first out of the money contract right now, with the stock at 71.25. Here's 217 for April week 2. And this one's got a little bit more going on in open interest, so this could be interesting. You're not completely making up the difference in terms of what you would lose. But again, if you're going to be taking an active approach in managing these trades the way that you're talking about, Barry, the method isn't necessarily to try to recoup the loss in one trade. It's the cumulative sum total of all of the trades together that they're going for. And so this, if your preference is to maybe work with the stock at a lower price with a little bit further out in time, that may not be the worst idea. Here's April week 3. 71 is 234, not a ton better. So that's interesting. Yeah, and then if it kept falling, you would do it. He would keep doing it again. Keep doing it until he finds a stabilization point, and then he'd keep rotating those trades. So you're absolutely right. Okay. So that's CVS. That's interesting. Again, as it stands, I'm going to go ahead and take that assignment. Yeah, Gib 71 looks interesting. I'm not going to lie. especially given the way that open interest is shaking out on these. I'm not even sure. Let's take a look at open interest on the week 3. Looks like anything week 2 or week 3 and out is not seeing a lot of volume, but there is open interest. And the volatility profile. Okay, outstanding. So let's look at the Greeks really quickly. Implied volatility here, 41.12. So Barry's not in on CVS, but might consider it next week. I am in on the trade, so you may be, if you consider it next week, you may be you're likely to be considering it a much better price than I am, which is good. The volume profile. Okay. Sorry, I misread you, Gib. No problem. But yes, if you want to talk about liquidity in terms of being able to get in and out of trades, then I agree. I certainly do agree with you, Gib. The potential for movement, timely movement in around this 71 level looks much better once you get out to week 2 and 3. Let's go out a month just for the sake of argument. And now we're getting into very low open interest again. So week 2 and week 3 is where it seems the most activity is happening right now. So Barry might get some check marks next Friday. You always get check marks, Barry. Let's face it. All right. So we'll see. We'll see how this one shakes out. But that's the way that things are looking right now. The next put sale expires. This is week 2 of April, 410. So this is on Pfizer. I sold the $27 strike price on this one, bringing in about 65 cents, about 2.41% for a 3-week trade. Now, in the interest of full disclosure here, this is one of those stocks that I've been holding for a little while after being assigned at a much higher price. So this particular put sale for me, first of all, this is a functional trade with a price on Pfizer that is just ridiculously discounted, which makes it really interesting. But for me, this is also an opportunity to not only was able to lower my overall net cost a little bit with some additional premium on it, but taking an assignment on Pfizer at 27 also gives me a way to average my net assignment price a little bit lower. If I am assigned on this one, then it'd actually take my average assignment down to about 33 and change, something in that neighborhood. Barry's not in this one either, just got out of it from a while ago, and that's totally fine. Sometimes especially if you've just gotten out of a trade, you're willing to let it breathe a little bit before you get back in, right? And to be fair, this is one I'm going to need to reset my chart. There we go. Pfizer is one. If you're a little bit exhausted on this one, it's totally understandable. Look at the way that this thing has moved all the way since 2020, early 2022. We have a peak all the way up here in the $60 range, and then it started to fall. And it's only been doing that ever since. Lately, we're starting to see this new upward trend starting to develop, but it's still got a long way to go to get back to where it was. And in fact, my original assignment was over here in the $50 range. Back in late 2022. So I've been watching this fall for a long time. I've been holding the position because again, the even uh, even at 50, it's still a deeply discounted stock. And the dividend has been useful enough to keep me interested. And at the current price, obviously this is not the dividend yield I am bringing in, having been assigned around 50. But for those of you who may be considering Pfizer as a new position, if you have the same trade open that I do, then this is actually really attractive in terms of dividend. And this is one of the things that speaks to just one of the elements that's attractive about this stock. Um, but it's also diverging from the market a little bit right now with this upward trend and currently showing some good momentum higher off of this last pivot low that came in, it looks like in February and March. So it also has some resistance. Let's be very, very fair at a little bit below 28, a little bit above the current price. We'll just go ahead and call that 27.75, I guess. And so it is going to be interesting to see if it can push. Is it going to push above this, or is it going to form another pivot high and drop back again? Not really sure. We've got some time for this one to play out, though. So even if I do take an assignment here at 27, that's not the worst thing in my book. So we'll see. But if you want to go look for some other things like Barry is doing because maybe you were already in it, nothing wrong with that at all. But here's the 65 that I brought in when I placed this trade last week. Let's just go ahead and check in on this. There's still a couple of weeks to expiration on this one. Now, if I wanted to buy this back, and I have to pay 36 cents, that's not quite 50%. And so for those of the active rollers, Barry mentioned Joe and some of the others, the rule number one for rolling is to consider the roll at around 50% of your original premium. If you can buy it back at 50% of what you brought in, then that's something that a lot of rollers are going to be pretty happy about doing. I brought in 65 cents. So this is not quite that level. That would mean that the asking price would need to go to about 32.50. But it's also been in that range today. So the stock's momentum, if you are worried about the larger, broader conditions of the market right now, maybe adding some additional pressure to any additional upside on Pfizer, and you want to avoid that assignment. Not a recommendation as always, but that is something that is probably doable right now. I'm looking right here at the day's range between 30 and 35. So that's interesting. That would be a way to still hang on to a little over 1%, and you've turned that, instead of a 3-week trade, a 1-week trade. and you've eliminated, and it would eliminate the possibility of taking that assignment if the stock were to suddenly pick up bearish momentum in the next 2 weeks. Again, if you're thinking about the idea of trade management and risk management, that's actually, I think that makes some sense. Unlike CVS, lots of open interest, enough volume here that I'm really not too worried about liquidity with any trade that you want to make here at this with this contract. So, as always, I'm going to let this play. I'm not turning a blind eye to what the market is doing, but I am willing to let this continue to play out. The last trade is exactly 32 cents. So that's interesting. Okay. Let's just go ahead and take a look at the trades that we have that placed earlier this week. The put sale is on Levi, selling the $17 strike price, bringing in almost 3% on this one. So this is for a I just realized that I did not put in the duration of the trade for any of these. Let's see. So these are all 3-week trades. Here we go. So 23 days to expiration on these ones. I do think it's worth pointing out as well right now. My one of the things that I try to do with my put sales is to make sure that I'm selling short periods of time, no more than a month. There is a temptation sometimes when you're selling put options to try to sell more time and therefore bring in larger premiums. I've tried to demonstrate how selling shorter expirations works better in the long run by increasing the compounding effect of your income generation. But it's also worth pointing out here, especially under current conditions. Remember that when you sell a put option, what you are doing is giving somebody else the right to force you to buy the stock at the strike price that you've sold. That means that what you're doing with put sell is a net bullish strategy. When bearish conditions are increasing, then the bullish strategy is generally the risk profile is starting to increase. When you're thinking about options and risk, especially as an option seller, let's remember that we're trying to flip the risk profile that is normally associated with options trading. For option buyers, the way to minimize risk in an options trade, one of the ways anyway, is to buy more time. So the corollary to that for a seller is that selling more time increases your potential risk. If you're trying to avoid assignments, you're increasing the likelihood you're going to take an assignment you didn't want. Even if you are willing to take assignments, by selling more time, you are not only increasing the likelihood that you will take an assignment, but that you may do that in an environment where, especially right now with broader conditions being a little bit more bearish right now, you are increasing the risk that you're of taking an assignment in a situation where the downside is more accelerated than normal. So try to keep that in mind. That's another reason that that I really prefer to try to stay within 30 days for all of the trades that I place. Barry says you got into Levi last Friday, expiring today at 1750. Okay. And 17, so Levi now is at 1821. So here's your first, there's your first check mark, Barry. I told you you were going to get some because you made this a lot more conservative than I did by selling even less time. And he still had a very functional trade at 1.43% for 7 days. I went out 3 weeks. And you also got in ahead of me last Friday versus placing the trade this week. I sold the 17, and the interesting thing on this is kind of like CVS, where there's plenty of open interest, not a ton of volume going on right now, which is why we have a pretty exaggerated spread between bid and ask. But the current action on this one, let's go ahead and switch over here to Levi. There we go. 17, the stock was up here when I placed my put sell, so it was actually just a little below 19. When I sell my put options, I'm not just looking for the first at the money contract. I'm actually trying to look if I can usually go a couple of strikes out of the money, then I usually prefer to do that, simply because it makes the trade a little bit more conservative by giving the stock a little bit more distance between where it's at right now and the strike price that I'm selling. I'm giving myself a little bit of a cushion. And so my assignment is all the way down here at 17. And again, I'm not saying that it couldn't reach this level, but we're talking about a support level that was last seen in June of last year. So this is a pretty solid level. This is a level I'm pretty comfortable with, not only from a technical standpoint, but obviously the value proposition becomes even better at that point. But what I'm seeing right now is pretty solid support right in the $18 range, and kind of a near term. We're seeing some consolidation here in Levi that could be a positive thing. So there's not enough going on here to make me want to change my trade at all, and there's not enough volume here to say that I really have an opportunity to do that yet. But I can also afford to be patient with this one. The other trades that I have are covered calls, and these ones are so the Verizon covered call. This is just, I've had an opportunity to do this a couple of different times on a stock that I've been holding now for a few years. To be, again, in the interest of full transparency, I was assigned this one quite some time ago, and so this latest momentum has been a positive thing, giving me an opportunity to sell a cover call a little above the $50 strike that I was assigned at. Yeah, I've been sitting in this for quite some time. So I still don't know how stable or sustainable this current momentum in Verizon is. But for now, I'm going to take it at face value and appreciate the opportunity that it's given me to add some additional income on this 90-cent covered call with the 51 strike price, almost 2%, 1.8% for 3 weeks. And if I get called out, I'll have a little bit of a profit baked into it as well. Let's just look at the longer term chart here. So I started working with Verizon somewhere in this neighborhood, again, all the way back 2022. So this has been an exercise in patience. Verizon is a really good example of a stock that is there. Verizon, AT&T, even T-Mobile are interesting companies right now because uh, in current conditions in the market, put a little bit more risk on companies with a global footprint. Verizon, AT&T, telecommunication companies are interesting right now in part because they don't have that same exposure. It doesn't mean they don't have some economic, some tangential exposure related to broader economic conditions. But since their footprint is largely localized in the US, so a lot of those global pressures don't exist for them in the same way. And that's one of the reasons why I think we're seeing uh, over the last several weeks a very counter trend move relative to the rest of the market in these. I think what some of this was a flight, quote unquote, a flight to quality into some of these telecoms where their global exposure is so much more minimized. So yeah, Barry's got Verizon in his portfolio. It's a holding stock with its dividend yield. It is a cash machine, and yes, this has a very nice dividend payout, even at the current price. And if you're somebody that got in maybe down here or even anywhere in here, then it's even better. And their fundamentals are very solid. The the strength of this rally is impressive, kind of intimidating. Like I said, from a technical standpoint, I don't know how sustainable it is, but the underlying business for Verizon is really, really very impressive. So, very good company. I do agree with you on that, Barry. But this is also kind of like you were talking about with Pfizer. You just got out of it. You wanted to kind of let that breathe for a little bit. I've been in Verizon for long enough that if I get called out, I'm okay with that. And I may let that breathe a little bit. 2024 at 41. So Barry, there's you already had one, and you beat me with Verizon. So nice. Getting in at 41 is that is a nice price. So good deal. All right. And then the other one, let's see, Barry, you said you're assigned Delta at 64 on 36, bringing in 1.43% for 2 days, which is amazing. Yeah. Here we go. Fine. 1, 2, 3. There we go. On 3/17/26, sold a $66 call expiring today, bringing in 1.88%. So that's just keeping the income generation machine going. There you go. And Delta, you could get called out of this one. We'll see. We'll see where this one lands, obviously, at close of the day. It is down, so it's right around your strike price. But if this shows any kind of positive momentum in the end of the day, you could get called out of Delta as well. So that's interesting. Isn't it amazing how even when everybody else is trying to beat the scare drum out of the market, right? And we want to talk about how bad things are. There's still opportunities to be found to place really, really good trades. Yeah, you're okay either way. You bet, absolutely. There's still opportunities to make not just good trades, but smart trades that make sense not only in terms of the income you're generating, not just in terms of the fundamental strength of the company, but even in, Verizon, even Delta right now, they don't exactly fit the pattern of the market right now, and that's a good thing. So this is one of the reasons why I think running scared from the market doesn't always make sense. Being conservative about your position sizes is at a premium right now under these conditions, because it not only does it limit your exposure in any one trade, but it also increases your flexibility and your ability, the opportunity to keep placing these functional trades. That's a net win. That's a good thing. That when I had somebody, I had a friend just at the end of last week ask me, "So how are your trades doing, Fred?" You can kind of hear by the, sorry, Thomas. Um, he asked me, "How are your trades doing?" You could tell by the tone of his voice that he was like, "Boy, the market is just tough right now." I just looked at him and I said, "My trades are fine." And he got kind of confused because he clearly uh, he's clearly operating from the traditional growth trading kind of a mindset. Well, this is one of the reasons I like being a contrarian. This is one of the reasons I like the approach that I like being the seller rather than the buyer. I get to control a little bit of the conditions that I'm taking trades in, and even when I'm taking assignments, I've had a few more of those happen the last few weeks, and they do happen in batches, but they're happening at prices that I'm willing to work with those stocks at. We're talking about stocks like Verizon, for example, and others. Pfizer, hey, guess what? If I have to take a little bit, if I have to take an assignment and hold on to those shares a little bit, I get to sit and just take in my dividends, and that's a good thing. And so that gives me uh, an emotional cushion that makes it easier to deal with. Um, our friend Carl loves to talk about the sleep test, and I love to talk about the sleep test too. Like, if you're able to sleep well at night while you're placing these trades, then you're in a really good place. If you are placing these trades and they're keeping you up at night, you're worrying about what is going to happen the next day, or whether or not you are exposing yourself in any extended kind of a time frame to more risk, then you're probably being more aggressive than you should. And if you're not being too aggressive with your strategy, then you're probably being too aggressive with your position sizes. So you've got to try to find the right balance, not only between the method that you're trading, the strategy that you're using, but also the way that you're managing each and every one of your trades. And if you can find the right balance there for those things, then the sleep test should be easy. All right. It's a little bit of a soapbox. I apologize. The uh, the other covered call that I have is on Bristol Myers. This is one I just took an assignment on it at 57.50, and the stock had rallied pretty strongly, going up to 59 earlier this week. Let's check in on this one, see where it's at. And it's still showing, it looks like it's hitting some resistance right here at the 20-day moving average. So we'll see if that holds or if it drops back again. My assignment is all the way down here at this pivot low, 57.50. So this is a trade that's got some room to play. And if I do get called out, that's a nice there's some nice capital gain built into that one. So again, I'm very comfortable letting this play out, and I definitely want to get this dividend. So as things stand, this looks nice. And again, this is another one where the dividend yield is pretty attractive, 4.19%. These are stocks that are I don't mind the assignments on these. Now, I do want to look for a second at Nike and CPB. I said sometimes you take assignments in batches. That means not only that you're going to take more assignments, but also you're going to take assignments in stocks where you're not going to be seeing the same kind of movements in all of them at the same time. Bristol Myers gave me a covered call right very quickly after being assigned. Nike and CPB not so much. These ones are following the pattern of the market. This is a good example. Nike is, I was assigned at 62, and I am $9 to the negative right now. Excuse me, $10, a little over $10 to the negative, as it looks like we are breaking down below the stock's 52-week low. So bearish activity is accelerating here on this one. And with the earnings report coming up here in the next few days, this could be getting more serious. I was assigned at 62, so we've seen this big drop. This is a gut punch. Let's not kid ourselves here. Now, I still like Nike at 62. The fundamentals are definitely not in agreement with what the stock's price action is doing. Stock's price action is 100% right now correlated to some of these broader conditions that are going on in the marketplace. Nike is one of these companies with a global footprint. Supply chain challenges that are happening as a result of, for example, the conflict in Iran and the impact it's putting on supply chains because of restrictions out of the Strait of Hormuz are real. Nike is a reflection of that. That could mean that the stock could continue falling. I'm not turning a blind eye to it. This is also, again, I've beat this drum a few times already, but this is where position sizing becomes so critical. I only sold one contract here. So yeah, it is serious. It is a significant push below right now, but still relatively manageable. CPB being assigned at 25 on this one. It's rallying a little bit today, but again, also my assignment is here at 25. So this is a similar story, maybe not quite as dramatic visually as Nike, but still, I'm still underwater by about $3 on this one. Very NVDL. So this is an ETF that is tied directly to NVIDIA. So its movement mirrors that of NVIDIA. A lot of tech stocks are seeing some pressures right now, some declines, and it's starting to approach the play zone for Barry. Gets back down in the 50s, maybe. I haven't done any updated analysis on NVIDIA in a while, but it's got this interesting channel. Not what I wanted. It's got this interesting channel going on. There's resistance. Here's support. That's been going on for most of the past year. So if it breaks down below this, that could start to get a little bit more interesting. It could mean that bearish activity is starting to increase in it. So might be worth seeing and watching to see if that drops far enough to make its value proposition even more interesting. So we'll see. All right, everybody, thank you so much. We are at time, so I'm going to go ahead and call it, but I appreciate your participation and for being here today. Hope this has been useful as always. And want everybody to have a good weekend. If you have any questions or anything comes up between now and next week, please don't hesitate to let me know. Reach out on Substack or on Discord. You can also email me, rebelincomesystem@gmail.com. Appreciate everybody and everything you do. Have a great week, and I'll see you next time. Thanks.